Hello everyone and welcome to Markets Analyzers. In this channel, we will break down complex financial concepts into an easy to understandable insights. If you are an investor looking to make informed decisions, understanding key financial ratios is crucial. Today, we are diving into the world of financial ratios. These ratios provide a critical insights into a company's financial health, performance, and market valuation. Financial ratios are essential for evaluating a company's performance. They help you to understand how well a company is doing, and we can know whether the company's stock is a good investment or not. We can find it out quickly through these ratios. I won't tell you all the ratios that are in the internet. I will just tell you few ratios which are very important to an investor. So let us now take a closer look at some of the most important ratios you need to know. In this video, we will learn about a total of 4 ratios. The first thing we should focus is on valuation of a company. The best ratio and one of the most widely accepted ratios for estimating valuation of a stock is PE ratio, price to earnings ratio. This ratio measures a company's current share price relative to its earnings per share. P means price of a share divided by earnings per share. I will explain how PE ratio works with an actual company. You can look at current share price of Tata Motors. It is 962 rupees per share. Now look at earnings per share. Come to their P&L statement, profit and loss statement, and look at this EPS, earnings per share column below net profit. And look at March 2024 EPS. It is 94.47. It means in previous year, Tata Motors has earned 94 rupees per share. So their current market price is 962 divided by their earnings per share, which is 94.47. We get 10.1. It means investors are willing to pay 10.1 rupees for every 1 rupee of the profit the company generates. If P ratio comes at 20, it means you are paying 20 rupees for every 1 rupee the company generates in 1 year. So now tell me which is good, high P ratio or low P ratio. Obviously, lower the P ratio, better the valuation of the company we are looking at. High P ratio means we should pay more to get 1 rupee profit a year later. On an average, P ratio of 15 is considered to be fairly valued. Above 50 means the valuation is high, below 50 means the valuation is low. To check P ratio, come to this website screener.in and search for the company you are looking at. I will search ITC, select the stock. The stock P is what we have learned now. ITC price is 420. Their March 2024 earnings per share is 16.39. 420 divided by 16.39, we will get 25.6. So the same value is mentioned here. You don't have to calculate it. You can just look at here. It means every 25 rupees you spend buying ITC, you will get 1 rupee in return a year later. I hope you are clear. Remember, P ratio is used for valuation purpose to determine whether a stock is overvalued or undervalued. Next, let's move on to profitability ratio. To know the overall profitability and efficiency of the company, we will use net profit margin. Net profit margin indicates how much profit a company makes for every rupee of revenue. The formula to calculate net profit margin is net income divided by revenue into 100. First, I will show how to calculate this. Again, type the name of the company you want. Let me type in ITC. Scroll down and come to their P&L statement. The formula is net income divided by revenue into 100. Net income for March 2024 is 20,751 crores. Net income and net profit both are same. Don't get confused. We will divide that by total revenue. The total revenue is 70,881 crores. So 20,751 crores divided by 70,881 crores into 100. If we divide them and then if we multiply them by 100, we'll get 29.2%. It means for every 100 rupees revenue ITC generates, 29.2 rupees is the profit the company makes. Higher the net profit margin, better it is. Net profit margin is used to estimate the overall profitability and efficiency of the company. Now the third ratio is liquidity ratio. With liquidity ratio, we can learn whether the company has the ability to pay its short-term loans or debt obligations. It means how much easily or difficult it is for a company to pay its loans. In this way, current ratio will help us. Current ratio formula is current assets divided by current liabilities. If you are an investor or if you are trying to buy stocks, I would encourage you to check out these ratios as well and try to observe what these ratios are trying to tell you. Now come to moneycontrol.com. In screener, I could not find current assets and current liabilities separately. In Money Control, type in the company name again, ITC, or let us look at some other company, maybe Infosys. This is Infosys symbol. Click on this, scroll down and click on financials. It will take you down to this page and then click on balance sheet. Then look at most recent numbers. It is March 2024. Take current assets under the assets page. Current assets are worth 89,432 crores divided by current liabilities, which are worth 38,794 crores. If we divide them, we will get 2.3. What does this 2.3 means? It means for every 2.3 rupees of current assets they have, only 1 rupee of current liabilities they have. It means in the next 12 months, if they get 2.3 rupees from their assets, they will only pay 1 rupee worth of liabilities. The financial health of the company is very good, is what this 2.3 rupees is indicating us. Try to select the companies which have current ratio of more than 1.5. If current ratio comes below 1 means the company don't have the money to even pay their loans, so we should stay away from such companies. Higher the current ratio, better the financial health of the company. Until now, we have spoken about valuation, which can be learned through PE ratio. The second one is profitability, it is net profit margin. Third one is to find liquidity of a company through current ratio, which we just discussed now. Friends, if the content was interesting until this point, try to hit the like button and share the video with your friends as well. So next, let's talk about a ratio which tells us how efficiently the assets of the company are being used. It is called asset turnover ratio. This ratio measures how effectively a company uses its assets to generate sales revenue. The formula is revenue divided by total assets. Type in the name of the company you want. Let us type in Maruti Suzuki. Click on the financials, click on income statement, and then click on annual. These are yearly numbers. Total income is nothing but total revenue. It is 1,45,951 crores divided by total assets. Assets will be given on balance sheet. Click on balance sheet, scroll down to assets. This is the total assets for the year ending March 2024. It is 1,15,353 crore. 1,45,951 crore divided by 1,15,353 crore, which comes at 1.26%. It means for every 1 rupee in total assets, the company generates 1.26 rupees in sales. If you did not understand, try to rewatch, you will be fine. Higher the asset turnover ratio, higher the efficiency of the company's assets. So these 4 ratios are some of the most important stock ratios that you should be definitely check before even thinking about buying a stock. The first ratio we spoke was about PE ratio. Try to find companies of PE ratio below 15. Lower the PE ratio, better the valuation. Next we spoke about net profit margin. It indicates how much percentage of the revenue is getting converted into net profit. There will be some companies which makes a very good revenue, but when it comes to net profit, it might not be very attractive, which helps us to find the profitability of the company. Higher the net profit margin, the better it is. And then we spoke about current ratio. This ratio tells us the company's financial stability, whether they can pay their short-term loans or not. Higher the current ratio, better the financial health of the company. And finally, we spoke about asset turnover ratio, through which we can understand how effectively the company's management is using their assets to generate revenue. With this ratio, we can also estimate the efficiency of the company. Higher the asset turnover ratio, better for the investor. Through these 4 ratios, we can estimate the valuation of a company, their profitability, their financial health, and the efficiency of their assets along with their management. So friends, finally, we came towards the end of the video. Try to like and share the video with your friends. Do consider to subscribe to our channel as well. I will come back again with another interesting video. Until then, have a great time.